Taiwan is up on your screen, 1.6% higher.
Maybe taking some money off the table may not be such a bad thing.
The Fed has already raised rates 3 times 75 basis points and is about to do a fourth 75 basis points move.
The deposits are, of course, very critical component.
Good opening for the Nifty, up about 120 odd points.
We are very close to new highs, and you could hit new highs sometime soon.
The story of the deposit side for the entire banking system seems to be indicating that there is a clear systemic issue with liquidity being low, so every bank is scrambling for deposits.
Look forward to an early resolution because obviously with high energy costs and the economic situation in Europe, the business, which is inherently fragile, will struggle going forward unless we take some calls very quickly.
For auto industry, at least festival season has been very good.
Another disappointing quarter which has come in for Gland. Revenue is down 3%.
Nifty is holding up with gains of about 80 odd points.
NBC is trading its steel business today, and that explains why, in fact, it appears that the stock is sharply lower.
Indian spice market is heating up, and the latest entrant in that is Dabur, with a 51% stake purchase of Badshah Masala for about 587 crores.
Markets are up in the green. We have Nifty sitting with gains of 45 points. Well, Dabur acquiring Badshah Masala was the only spicy part of the day today. Other than that, it was a day where the bulls gave up their gains on the index, and the Nifty actually came off quite a bit. This is Closing Bell. I'm Sonia, and joining me is Nigel and Mangalam. Well, folks, it was a market that sort of gave up, right? I mean, 90 points from the top. So we started with a bang, what the SGX Nifty suggested. And then from there, the Nifty is down about 88 odd points, facing resistance at that 17,800 mark. The global markets also assume importance. This afternoon, Europe is not looking good. There's a huge loss that Credit Suisse has posted, and there's a huge restructuring over there as well. That is sort of taking a toll on the European market. So just keep that in mind. But for our own markets as well, a lot of financials are dragging. The Bajaj twins are under pressure this afternoon. FMCG stocks, second day running. Nestle, Asian Paints, Tata Consumer, all down about 1 to 2 odd %, while metal stocks are gaining ground. So the JSW Steel, Tata Steels of the world. But having said all of that, there are plenty of stocks which are hitting 52-week and record highs. Bharti Airtel is at a record high, Axis Bank, Cipla. But Nigel, in the morning, I remember you saying that the risk reward perhaps is not in favor of going long, right? Yeah. And that's pretty much what has played out. The market actually has given up quite a bit of its gains.
Well, that's right, Sonia. It feels good to get it right? I mean, 17,800, that's appearing to be a bit of a congestion zone. And it appears the bears, they're pretty clear. They want to go ahead and defend the 17,800, 17,850. So for the third straight session, we have gone to that mark and have seen a bit of a U-turn. Now we're bracing for the final 60 minutes, which is expiry, obviously. And the broad range, going by the data that we have, is around 17,650. As well as 17,750 on the upside. We remember we're towards the lower end today. We're almost at the low point of the day as we speak. The 17,750 call as well as the 17,700 put, well, both of them are very active. So that's on the call side. So it appears that's going to be a bit of a resistance zone. The put, though, that's being written quite a lot. So you're expecting some kind of support in that vicinity of around 17,650 to around 17,670 odd. Remember, we'll be getting the 3 p.m. move as well. So let's see which way that swings. But for the time being, the bears, well, they are trying to put in a fight. We're still in an uptrending market till the 50 DMA holds out. But, we've hit that level thrice in this week and we've come off that. But Mangalam, what else? Mid-caps, plenty of the stocks are hitting fresh highs.
That's correct, and the 17,700 mark seems to be a bit of a fulcrum because that's where the tug of war for both the bulls and the bears is taking place. But what really stands out is that despite, the sensex just flattening out, about moving into the red, we have the mid-cap index, which has been doing well for the second day running. Remember, it did well on Tuesday as well before we went into that holiday. And today, the heartening fact is, even as the advance decline ratio, the lines are coming closer to each other. It is after Tuesday for the first time where we're seeing the advances far outnumber the number of declines, notwithstanding the fact that these guys are coming together in terms of proximity. The advances are still above the declines. The mid-cap index doing well with advances doing better is something that the street believes that maybe, there could be support in the lower levels for all the frontline indices. The Nifty Bank is doing well after some profit taking on Tuesday. And now the top gainers in the broader markets. We have big gains coming in on RBL Bank, decent volumes on that one too. GMR Infra is the other one which brings me to my Ken. And the other trend that sustains from Tuesday is the way PSUs are doing well. On Tuesday, we had a lot of these rail PSUs do well, and now that list has expanded to all the other PSUs as well. BHEL is doing well, REC at the high point of trade along with PFC, and Container Corp is the other stock which is doing well with volumes on its side as well. So let's see where things go right now. Like you said, the 3 p.m. move is something that we will all await.
Okay, all right, Mangalam. Well, let's get straight then to telling all our viewers what we have lined up on the show today. Remember, key indices, they've come off the day's high after a steady start to trade. The Nifty inching closer to around the 17,700 mark, currently trading a little bit below that. The mid-caps, the outperformers of the day. Sectorally, you have metals and relative stocks that are leading the charge. FMCG major Dabur surges on the back of an inline set of numbers. The company will also be buying 51% in spices manufacturer Badshah Masala. We'll decode the performance in the quarter gone by and the road ahead for the business with the company's CEO, Mohit Malhotra. A negative surprise on the margins front hurts Gland Pharma. The stock is down more than 10%. A detailed fine print on those numbers lined up on the show. And NHPC and SJV, and they rally on the back of a bullish CLSA note. Details coming up on the show. And we'll also bring you all the views on the market. We'll be joined by Rupen Rajguru of Bank Julius Baer. All this and more lined up in the next 60 minutes.
Okay, so we do have plenty to talk about in the next 1 hour. Going to be an exciting last hour of trade. We have Mitesh Thakkar joining in for some closing strategies. Mitesh, good afternoon. The market has given up a lot of its gains, so it's facing a bit of a hurdle at the 17,800 mark. You reckon that it could be a while before we take that out, or is it just a matter of a few days? And what do you do now? Are you looking to take any fresh long positions or stay away?
In fact, we've been advising, taking profits, and that's the kind of strategy which we have had. 17,800 is definitely a well-established pivot. Though I think on the stock side, we still have more of long or buy-side ideas. But I think on the index, I think it's a very clearly defined level on the hourly and the 2-hourly chart. So we advise taking profits and then suggested buying back around 17,650. We're practically there. We have had a low of around 17,670. So 17,650 is the entry point, and then you can take a 70-point kind of a stop from there. I think the markets will, last 3 days, we've maintained this view that the markets will consolidate between 17,800, 850 on the upside to broadly about 17,650 on the downside. I think that's the range which we are looking at. Therefore, buying around the lower of the range may not be a bad idea.
Right, Mitesh. We'll just come to you in just a short bit. The stock on our radar right now is Dabur. Posted their second quarter numbers that were in line with street expectations, but the bigger delta that came in this time around was the acquisition. The acquisition actually literally spiced up this quarter for the company, which was otherwise bland, in line with street expectations. We do have with us Mohit Malhotra joining in, the CEO of the company. Thanks a lot, Mohit, for joining in. The first question, of course, is with regards to the acquisition. You said that you will acquire 49% of Badshah over the next 5 years. So just wanted to understand, is there a valuation locked in for acquisition of that 49%? And now that you've gotten it into your fold, 250 crores is what you're expecting it to do with FY23. What does Dabur scale this business up to? I mean, you have a much higher distribution, a much bigger sales force. So how much can you scale this business up by?
Right. So, Mangalam, thanks for having me, and wish you all a very happy Diwali and season greetings here. And I think the results are pretty much in line with the street estimates and to our estimates also. So we were pretty excited, even without the acquisition. So, but on the acquisition, I think first is valuation definitely is locked in. So the multiples that we've given them, which is around 4.5 multiple on top line and around 19.6 multiple on the bottom line, that stays at the end of 4 years also when we acquire the 49% stake, and that's all actually been locked in. So after 5 years, we acquire the balance of the company. And in the interim period, we leverage the synergies from each other's strengths, which is sticky relationships which are there in this masala category, which the promoters have. And that's why we have the promoters staying with us for the next 5 years, so that there's an easy, smooth acquisition process which actually happens. And they, to your point, they've already done a 250 crores is the estimate for the current year. And we expect the business to grow at roughly around 20% CAGR and take the business from 250 to a level of around 700 crores in next 5 years' time.
All right, level of 700 crores in the next 5 years. So that means that, at the same multiple, you will perhaps have to eke out 2,500 crores in terms of acquisition for the remainder 49%. We'll talk about that in just a bit. Also wanted to understand the margin synergies, because currently they do around 23%, and this despite 82% of their revenues coming in from blended. That's a high gross margin business. So going forward, what kind of margin synergies can you eke out from this business, say in the next 4 to 5 years?
See, there are a lot of upsides in the margins which can be gotten, from distribution, because there are distribution margins which this company has been operating for so many years, but nothing in knee-jerk. Gradually and slowly, we will try to rationalize those margins. Plus, there's the distribution in terms of rural that we'll have. Plus, they operate through multiple levels of intermediaries, which also we will try to delayer that organization. The retailer margins, the stockist margins are also a little bit on the higher side as compared to what Dabur operates, or what the category at large actually operates in. So, but no hurry. So we will get those margins also rationalized. The second item is the raw materials that we purchase as Dabur and they purchase, there's 50% commonality. So as the scale of purchase goes up, there will be economies of scale kicking in, and that will also bring in a lot of synergies and cost cutting. Plus media. The company has not been doing a lot of media and demand building in terms of advertising. And Dabur is used to doing advertising, and we have some set deals and ways, systems, processes by which we buy media. So there will be a lot of synergies in terms of media processes also. And then the other strong management practices and processes which we bring on the table, we think will unlock cost efficiencies there also.
Right. Mohit, sorry to come in on this one. Mohit, just wanted to understand, what is the gross margin, EBITDA margin differential in Badshah? I mean, if it's doing 23% EBITDA margins, just wanted to understand what is the gross margin that it is doing right now?
So almost around 40% is the gross margin. At least.
So 40% is the gross margin they do with 23% EBITDA margins. 45% is the gross margin 50% is the gross margins that you do with around 22% EBITDA margins. Is that the way one should look at in terms of synergies for Badshah as well? I mean, can you realize some 300, 400 basis points from where we are right now? Can you give us a number?
Yeah, not exactly that number, but yeah, definitely around 100 to 200 basis points can be derived out of the synergies, but that will be plowed back into the media, because the media, if you look at their business, the media investments have been very low. So we want to do brand building, and we would extend the brand across geographies. So whatever upside that we will get in terms of operating margin, that will be deployed back into media to grow the business to the level that I mentioned of around 700 crores.
All right. Hi, Mohit. Nigel on this side. Congratulations on this acquisition. Quick question. You were talking about scaling the business to 700 crores in the next 5 years. So just to put in the numbers, for the remaining 49%, you'll be spending something around 1,500 crores. I'm going by 4.5 times price to sales.
That's right. That's right.
So around 1,500 crores, right, is what you'll be paying for the remaining 49%.
But these are the estimates of the growth numbers. So yeah, the numbers stack up like that. Yeah.
So this 1,500 crores that you would be paying for the remaining 49%, how do you plan to sort of fund it? Will it be from internal accruals? Would you look to tap the market at any point in time?
No, Sonia, we have enough money lying in our balance sheet. We got 5,600 crores which is lying in our balance sheet. Okay. So no debt to be raised here. So all will be internal accruals, and the money is already there, which was parked for these acquisitions only.
Since we have you with us, how is the domestic volume growth looking? I mean, what is the kind of trend that you're noticing now that the festive season is also upon us? In Q2, I mean, you've been for the last 2 or 3 quarters in very low single digits. What is the growth looking like?
See, if you actually look at the transaction volume growth that we actually do in terms of eaches and the pieces that we sell to consumers, more consumers, our volume growth actually has been around 14%. But that was more driven by our foods business. And therefore, the moment you value weight that volume growth, it turns out to be around 1%, which is looking very, very modest to you. But if you look at the CAGR for past 3 years, our volume growth has been in the range of around 9% on. And we expect to maintain that case sale volume growth already, because sometimes some part of the portfolio fires and sometimes it doesn't fire. Like this time in Q2, our healthcare was subdued, which is a high value, and that's why the volume growth is looking subdued. And the foods did brilliant. Our foods volume growth is around in the range of around 30% odd. So that fired, and that's why the weighted average volume growth looks to be muted at around 1%.
Okay, all right.
But broadly, we are pretty optimistic on the volumes going forward also, except for the high hump of the healthcare business, which is what we are lapping over.
Okay, all right. So two-part question then, Mohit. For the past quarter, there's 21% growth in the home care business sequentially. Was there any one-off out there? So that's point number one. The other factors, you briefly spoke about the health supplements and OTC business. For Q3, are we likely to see double-digit growth on a year-on-year basis on the high base?
Right. So first on the home care business, Nigel, we've registered a 21% growth. There's no one-off there.
Okay.
Our Odonil brand has actually performed very well, and that has grown by around 27%. And Odomos brand has also grown by around 20% odd. And Sanifresh business has also done pretty well for us. And there's been a market share increase of around 350 basis points, which happened on Odonil. So no one-off. On the second piece of health supplements, we don't expect it to grow by double digits at all in health supplement because we are navigating a very high base. The CAGR is double digit of around 11 of 3-year CAGR if you see pre-COVID to now. So we have a CAGR of around 11-12%. So we will expect a very muted growth in the health supplement business going forward also because of the high hump of the base which is there.
Right. Mohit, just to reconfirm your numbers with us, you had earlier given us a guidance of double-digit revenue growth, low double-digit revenue growth with mid-single to high single-digit volume growth for this year. Does that stay with around 19 to 20% margins, or have you made any changes to those estimates?
You see, 20% margin remains. That's the guidance. Around 20% of operating margin is which we'll maintain. In terms of the volume growth, I think volume growth should be low single digit because there's a price increase. The growth in all the categories are actually muted. So we're looking at a high single digit value growth with a low single digit volume growth.
Right. And what's interesting in Dabur over the last couple of years is that you are looking to enter newer markets. Just wanted to understand how the performance of your earlier launches, you entered baby care, etc., have been, and what's the total addressable market or TAM that you're looking to tap into going forward? What's your current TAM?
See, in terms of the food business, we've increased our TAM from existing 1,700 crores to something like around 10,000 crores. And now we are looking at entering the carbonated food drink markets also, which is also huge. And the source of business here becomes carbonated soft drinks, which is a 40,000 crore market. And our drinks, new product launches have done very well for us. We launched it around 2 years back. This year we'll be exiting at around 200 crores. The next 3 years we should be reaching around 500 crores with our drinks portfolio. So that is how we are actually expanding. And that is beverages. Now, if we move to food, we've already entered into pickles and chutneys, and now we've done this inorganic acquisition of Badshah, wherein the TAM increases because spices and condiment market is around 25,000 crores, out of which the blended market itself is around 12,500 crores, so that really gets extended. Plus, we've also gone into ghees and oils. So TAM is actually gradually, slowly increasing for us in most of the respective categories where we are present in.
All right, and the final question then, with regards to the capex that you've announced along with numbers as well, 326 crore is the capex that you've announced in both your juices as well as the toothpaste business. How much could that mean in terms of incremental revenue for you going forward?
So we're looking at, with this capex, around 900 crores revenue in 2 years' time. And therefore, we have an IRR of roughly around 40-45% coming out of this capex in the Indore factory facility that we'd already invested in the greenfield of 500 crore earlier. So that's why, because our food business is the demand is outstripping the supply. That's why there's a necessity to actually put this capex much in advance for us. Yeah.
Okay, you're doing so much, Mohit. There's the carbonated soft drinks market, there's the spices market, and you have cash on your books as well. Any more acquisitions that you're looking at over the next, say, 12 to 18 months?
So, acquisition happens per chance. One really don't know. We keep exploring, chatting. This acquisition of Badshah has come out of deliberations with the promoters for over around 3 to 4 years, building relationship, and now it has happened. So I can't really comment with conviction that we are looking at something. We're continuously exploring and looking at things which are synergistic and which have a strategic fit with the strategy of the company. So as and when something comes up, you'll be the first people to actually come to know. Yeah, but nothing as of now on the table.
We'll have to, try to touch base a little earlier than Mohit, because we have ears on the ground. Mangalam is constantly on the prowl, so hopefully we get a bit of a heads up on that front as well. But congratulations on this acquisition. You seem pretty positive on it. If you're looking at tripling revenues in the next 5 years, I think that's giving us a bit of a sense, and also synergy benefits to the tune of around 100 to around 200 basis points. It's been good speaking to you. Thanks so much for stopping by, Mohit.
And also got us thinking about all the biryanis and, and all the chicken tikka that you can make using the masala, right?
Yum.
Since morning, whenever people talk about Dabur, that's all I'm thinking about.
All right. Well, by the way, the markets have moved into the red, actually. So we have come off considerably. The Nifty just moved into the red as we speak. And the advanced decline ratio as well. You have more number of stocks that are declining now in comparison to the number of stocks that are advancing. Crisscross lines should come up for you on the screen. Slip into a short break. Come back. We'll talk on the markets. Rupen Rajguru of Bank Julius Baer will be joining in. Well, marginally holding into the green, but let's see what happens in the next 40 minutes, because things are likely to get far more volatile given that it's monthly expiry. Well, let's get chatting about a couple of stocks then. We'll talk about the hydropower stocks as well. So NHPC as well as SJVN, both of them are in focus. That's post a CLSA upgrade. Vivek is with us to run us through all of those details. Vivek?
Good afternoon. Well, both of these stocks, it's the hydropower sector that's in focus, and both SJVN as well as NHPC have been the stocks that have actually been on a tear since the initiation note done by CLSA a month ago. Now, what's actually happened is that CLSA has written a follow-up note on both of these stocks, where they've further upgraded the target price. So what they've done is they've upgraded the target price on NHPC to 55 from 51 earlier, and on SJVN to 44 from 42 earlier. What is it that enthuses them as far as the hydropower space is concerned? Number one, they believe India is extremely serious as far as reaching its net zero targets that it has publicly stated, and they believe that some of the key beneficiaries would be the hydropower sector, given the kind of inherent benefits that this particular space has. As far as NHPC is concerned, what they're saying, they're forecasting the company's revenue earning equity to double over FY22 to FY25. So that is something that is really enthusing them. And what they're saying is they're expecting the EPS to increase by 45%, and the company should be able to expand its ROE by almost 236 basis points. Coming to SJVN, what they're saying is they're forecasting a revenue earning equity growth of almost 131% over FY22 to FY27. So very strong earnings growth is what they're seeing, and which is why they're even more bullish on these two stocks today.
Okay, thanks a lot for that. By the way, the market has now officially given up all of its day's gains. It's moved into the red marginally, the Nifty. And a lot of these tech stocks that have been decent gainers this month are now coming off. So whether it's TCS, Wipro, Infosys, all in the red at the moment, down about 1 to 1.5%. Deven Choksi is still with us to discuss a couple of stocks. Deven, I don't know if you heard the management of Dabur just a while back, but they're very optimistic about this acquisition. They're saying that they're going to take this business, the Badshah Masala business, from 250 crores to 700 crores in the next 5 years. And it's 40% gross margin, so it's a pretty high margin business. Do you like this stock?
Hey, Sonia, good afternoon. Well, certainly, I believe that I think the masala markets, the spices market, I think that's, which is what we call it as, is likely to double from here onwards. I think from 25,000 crores to about 50,000 crores in next 4 to 5 years from now. And given the kind of a size at which it is growing, plus, I think the way in which I think consumer is moving towards the organized market, I will not have much doubt in my mind that I think the size will grow even faster than what they have projected. Should that happen, I think the business remains extremely profitable though. And I think this is where probably I think one could argue that I think 500 crore or 700 crore in next 3 to 5 years time from current volume of around less than 200 crores in the revenue. I would think that I think the business probably would, I think, demand higher amount of attention. Currently, they have ended up acquiring this company at, I would think, around 5 times the top line. Maybe I think the valuation could possibly scale up if the margins are going to remain on a higher side. So yes, certainly I think the food category of FMCG business is all I think talking about the organized market, and that's where I think this acquisition could make more sense going forward for companies like that.
All right, Deven, thanks so much for stopping by. A short but an effective chat today. We look forward to touching base with you in the next few days. Well, as promised, let's hop across to Rupen Rajguru, Head of Equity Investment and Strategy at Julius Baer, who joins in. Hi, Rupen. First, season's greetings, and thanks so much for joining in. Our markets have been resilient. That's really been the big theme, and we have decoupled from what the globe has been doing, which is pretty good news. My question to you is, at this juncture, are you still constructive, or are you getting a little bit cautious on the Indian markets?
Okay, hi. Good afternoon, Nigel, and wish you and all your viewers a very happy, peaceful, and profitable Samvat 2079. You are absolutely right that Indian market have been, so to say, the star market in the entire globe this year, one of those large markets. And I think there are a couple of reasons for attributed to that. One is, after a long haul, our earnings momentum has come back significantly. So between 2020 and 2022, the Nifty earnings have compounded by 30%. And between 22 and 24, if I were to just go by general consensus, the expectation is around 15% growth. So I don't think so any other country, large country globally, will have such kind of earnings momentum. Secondly, also from a macro standpoint, India never overstimulated its economy. So while globally people are unwinding, India probably does not have to do much of unwinding of liquidity while we have to hike our interest rates. But at an aggregate level, our macros are much better. And finally, the domestic flows have been resilient. From the market perspective, while at an index level, as I spoke with you last month, we don't see a big upside from where we are currently. But there will always be stock-specific bottom-up opportunities which are there, and probably that will be an interesting part in India going ahead. So to answer your question, no significant upside, at least over next few months at an index level, but definitely there will be stock and sector-specific opportunities.
Right, Rupen, season's greetings to you, your family, as well as your team as well. You spoke about sector-specific opportunities. I'm looking at the cement pack today. It's making a bit of a comeback. We have Ultratech, which is moved off the lows. At the high point of trade today, we have ACC, Ambuja, India Cements doing extremely well as well. You expect some sort of margin improvement in the third quarter? And if one has to play this, how does one play it? I mean, through the large players or through the mid-cap ones who are trading at sub-replacement valuations?
Sure. Yeah, hi, afternoon, Mangalam. This quarter two probably will be one of the worst quarter as far as numbers are concerned for all cement players. Already a lot of players have declared their numbers. And because this quarter was double whammy, the pricing was also lower, and plus it was seasonally weak, and the input cost had gone up significantly. So come December, we will definitely see improvement in all counts, volume, pricing, as well as the cost coming down. So we'll see a sharp quarter-on-quarter improvement in the December quarter. So from a overall sector perspective, as we are expecting the overall economy of India also to have a good momentum in the run-up to the election, and typically cements as a sector does well pre-election, we expect over next 3 years at an industry level volume growth of close to 7 to 8% versus the supply growth, which will be closer to 5%. So in that context, it is in a sweet spot. From a player perspective, definitely, we will have a barbell strategy wherein on one end we will have the large or the player who has a pan-India presence, because as I said, this sector is going to do well across, and also some mid-cap names, because definitely after the one big M&A which has happened, there are expectation of more M&As out there. So some good mid-cap players which is region specific, having a decent capacity also would be something to watch out for. So some of the players which are at sub $80-90 valuation would definitely look interesting.
Okay. Rupen, hi, good afternoon. So, how do you play this volatile market in terms of themes? You referred to some of them, but what do you think could be the big themes to follow over the next, say, 12 to 18 months? And which are the spaces to avoid entirely?
Hi, afternoon, Sonia. The themes which we like are probably, typically we like structural themes vis-a-vis the cyclical themes. And within structural themes, we look on to which theme has a tailwind. So currently, as we speak, over next 2 to 3 years, the domestic focus companies have a tailwind. Definitely financials is a big theme which I've been talking to you guys for a long time, which we like. So that's a big theme to play. Along with that, I mentioned about cement. As a capex, as a theme, we like. But what has happened, the capital good companies, the stocks have just gone up significantly. So while we probably at the current juncture, probably we would like more of companies which are into project management and execution, because the valuations there have not gone up as much as the capital good or the product companies. So that's the other segment which we like. From an avoid perspective, if we are going to get into, even if it were to be a technical global recession, so the global plays is something which we would avoid. While IT as a sector has seen a decent correction this year, but I would say we would still be avoiding mid-cap ITs, wherein large-cap ITs definitely at a price point starts to look interesting. So some of the, not the top two, but the number 3, number 4 IT companies whose valuations have now gone down to say 17 on a multiple basis, those have started to look interesting, but we'll avoid mid-cap ITs. And probably selective, while we like healthcare, but we are selective on pharma stocks as well. Okay. And we'll avoid some of the commodity plays, because if we were to get into a global recession, those sectors will get definitely more impacted.
Okay, all right, Rupen, so you're saying mid-cap IT is what you'll avoid. From large-cap IT, you like the larger cap names that maybe not in the top 2, but the others which have a bit of valuation comfort. Just putting that together, that could be HCL Tech Mahindra. You didn't say it. I'm just trying to zero down on a couple of those names because that's what's fitting the bill. Let's talk about the auto space though. One consensus is definitely banks, financials. Some part of the street still believes that autos have some steam in that. Do you think so as well?
Automobiles had a terrible cycle from say 2018 till 2021, right? And we have just seen last few quarters wherein the numbers have started to pick up. So from a sector per se, what we believe that next 1 to 1.5 years, definitely the sector will see a revival in volumes, because all the concerns which were there, the chip concern which was there last year is no longer there. The input costs which had gone up are also now easing. The oil price also, while it has not come up significantly, but still lower than what it was some time back. So all those tailwinds are there. And finally, what we are seeing also the pent-up demand is there. So our pecking order in the auto, while would be we like CVs, so there probably the second largest player is something which we like, and then comes 4-wheelers, and there again the leader is something which had lost market share and now it's fighting back to regain market share, and that is something which we like. And the least preferred would be the 2-wheelers, because there the competitive intensity is very high, and we have already seen the EV penetration, at least in 2-wheelers, is significantly going up, and probably not many listed players are, barring one, are very much entrenched into the EV game in 2-wheeler side. So that would be our pecking order in autos. So to sum up, while we believe that the stocks have gone up, but still, at least for next few quarters, there is good growth which one can see.
Right. Rupen, I'm interested in your contrast strategy, because I'm just looking at it in terms of healthcare. You're looking at diagnostics and hospitals. That's a contra positive that you have here. I mean, we've seen a 30 to 50% correction in all these diagnostic players, and that's primarily because, post-COVID, there has been a drop in the tests that they're doing. And at the same time, even hospitals, we've seen a cut of anywhere between 16 to 25% in the larger players that we have there. What makes you positive about this space? Is it just the valuations after the correction, or do you believe something can change?
You partially answered it, Mangalam. I think last year they were darlings, and at least in our mind, nothing could go wrong with especially diagnostic plays. So what had happened last year, there was a bump up in their revenue thanks to COVID, and on that higher revenue and higher margin and profitability, market gave a even higher multiple. Currently, we are seeing exactly the reverse of that. So now that COVID-related bump up is no longer there in the revenues. Plus, there has been negative operating leverage. Margins have come off, and while ROCs are still healthy, but probably majority of things which can go wrong have gone wrong. But the question which we have to ask is that is the structural story still there, or it's gone? We strongly believe that from an India perspective or diagnostic as a play at a big level, we believe it's a shift from unorganized to organized. So the organized guys will get higher market share. So that theme is very much there. And secondly, also while the competitive intensity is there, but probably with a better health insurance coverage, the volumes and business for diagnostic player will definitely go up. So we remain positive on that theme from next 2 to 3 year perspective, while there might be some quarterly moments here and there. So we like that. And similarly for hospitals, probably we like those hospitals which are which have done their capex, and we believe that it would be a good operating leverage play. Some of the hospitals which have done capex and will be a pan-India players is something which we like.
Okay, all right. We will leave it at that, Rupen. Have a great one. Thanks a lot for joining in. And once again, happy Diwali to you and your entire team at Julius Baer. Let's do one thing. Let's take a quick commercial break for the market. It's not bad. It's a little volatile, but now flitting above the green line and a little bit of a recovery in the last 10-15 minutes. Nifty back above 17,700. But when we come back, we'll get you our favorite segment, the dealing room chatter, D-Street chatter coming up. We'll tell you also what to buy today and sell tomorrow from our technical experts. Stay tuned. All right, ahead of the earnings tomorrow, we'll get you key expectations from large caps like Dr. Reddy's, Maruti and Tata Power. Stay tuned.
Welcome back. What a good recovery it's been from the lows on the market. The Nifty now hovering around that 17,700 mark, a little over that with a gain of almost 70 points. We have the Nifty Bank, which is doing extremely well as well. I've managed to catch hold of Nimesh, who's come. He was camping around trying to get some views from the dealers, etc., the insight as well. Nimesh, what do you have for us? Where does the expiry look like, and more importantly, the triggers for the next series?
Well, Mangalam, clearly because of the expiry, you're seeing that the last half an hour of volatility that normally plays out during all expiries, and that's playing out today as well. But purely from a technical point of view, I think Nifty is struggling to cross the 17,800 level mark on a consistent basis. So that's a level which the bulls will like to see that if it crosses in the new series. So that's something to watch out for. Again, from a flow point of view, it's largely driven by expiry, so that's nothing much to read into the flows as well. I think what's happening today in terms of sectors is clearly mirroring as to what's happening in the global market. Right. So metal stocks are rallying, and as we see, the dollar index cooling off to sub 110, so that's playing out in the metal names. At the same time, some of the mid-cap IT stocks are under pressure today after what we saw in the Nasdaq in the last 2 days. So that's clearly what's playing out in the global markets. Is that playing out in India as well? But as I said, technically 17,800 is the level to watch. But I guess for the November series, there are a lot of big events to watch out for. The fag end of the earnings season. We have the MSCI coming up, in mid of November. There's going to be the midterm elections as well in the US. So a lot of cues are stacked up for the other markets as well for the November series. But for today, I guess the volatility is because of the expiry. But 17,800 on the Nifty is a very important level for the bulls to watch out.
Take that point. That's on the macros and the index. But individual stocks, that's where all the action, the masala is.
That's where the action is. So the first stock on my radar today is Newgen Software. There was a large block of almost 3% equity changing hands, and I believe one of the institutional FI was a seller in today's bug deal. So maybe the disclosures will be important in the post-evening if there is indeed any disclosure in Newgen Software. So that's the first one. The second stock is Hindalco. We spoke about how the entire metal pack doing good today on the back of dollar index cooling off. But for Hindalco, there is follow-up buying as well from the larger FIs. So it looks like within the metal names, this is one stock which has likely been backed by some buying as well by the larger FIs. So that's second stock. The third stock is Cipla. Within the pharma names, a lot of pharma stocks have corrected today, but Cipla stands out for the last many days, and even in today's trade, there is a good amount of buying interest from the larger institutions. So the delivery volumes are going to be quite high in Cipla, and that's backed by FI buying for the last many days, and that's been the case today as well. The last stock is Max Financial. This is an interesting one. That stock is under pressure of late. We saw the IRDA rule as well, which came against them, and there was a small fine. But looks like the pressure of late is largely because one of the leading FIs is a seller in Max Financials, and the overall feedback is watch out for deliveries consistently, because looks like that's pretty much towards the fag end that FI selling seems to be getting over. Once that gets over, you'll see a bit of uptake in that particular stock. But the pressure of late is because of one of the leading FI is a seller in Max Financial.
All right, Nimesh. All right. Thanks, gentlemen, for joining in fact, giving us a quick insight. By the way, at the start of the show, we pointed out that the range for the final hour will be around 17,650 to around 17,750. The low of today is 17,655. Now, it's important to note that we're moving towards the upper end. If somehow the bulls can get us past the 17,750 and hold there for a few minutes, well, I'll tell you what, we could see a bit of a bounce even from there. So around 17 points away, 16, 17 points, we've seen a good recovery in the last few minutes. With the 17,750 call writers, they'll be getting a little bit nervous after seeing this sort of a recovery on the Nifty. Keep an eye out, 17,737 is where we are at. Mitesh, expiry playing out. What do you make of the index move and also individual stocks?
That's right, Daniel. I think also is the fact that, you are kind of hitting the lower end of the range, closer to about 17,650, which is what I had indicated. So I think that consolidation on the hourly chart, signal remains, and the overall setup is still positive. So maybe 2-3 days more of this kind of choppy activity could continue. On the stock side, I think REC is something, and both REC and PFC have broken out. So REC is something which I can recommend as a BTST kind of a call. Keep a stop below levels of 95 here. Look for targets of around 99 on the upside. And the other one which I like, apart from REC and PFC, is a BTST on PVR, which I would recommend taking a position with the stop below 1729 for targets of around 1760.
All right. Thanks a lot, Mitesh, for that. So those are some BTST trades. Before we wind down for the day, we just have, about 15 minutes left. Before we do that, let's tell you what to expect from Maruti's numbers tomorrow. They're coming out tomorrow at noon, and the expectation is that it will be a very good set of numbers, purely because there was a low base, A, and B, there's been a big demand recovery. So just look at the numbers. Revenue growth of 44% is what we're expecting, because the volume growth has been very strong this time, both year-on-year and quarter-on-quarter. It's a 36% year-on-year growth that we've seen in the volumes at 5.17 lakh units. The margins as well will improve to 9.3% versus 4.2% same time last year. And the profit growth will almost quadruple. Of course, very low base, so the profits are expected at 1,847 crores. Now, as I said, the volume growth has been really strong. One, because of easing supply chain constraints, and two, because of an improvement in the wholesales data, because of the channel inventory, which was very low, and now it was filling up. So in this quarter gone by, there was a lot of inventory that went to the dealers ahead of the festive season, and hence wholesale numbers look good. The margins will improve quarter-on-quarter because of price hikes, operating leverage and forex benefits. There's a benefit of the yen depreciation against the rupee, and that will result in a lower cost of raw material imports. Remember, 7% of the direct and indirect raw material imports are yen denominated, and the average selling price will also rise about 1% quarter-on-quarter. The key things to monitor is the success of the upcoming products, especially in the SUV segment, and that will determine the way forward. But these numbers will look very good from Maruti. But let's also find out how Tata Power's numbers will look. They come out tomorrow. Vivek is standing by to tell us more. Vivek, over to you.
Well, good afternoon. So Tata Power will be reporting its results tomorrow. On a consolidated basis, we're expecting a steady, slightly strong quarter from Tata Power this time around. Revenues are seen higher by almost 29%, coming in close to the 12,600 crore mark is what the market is anticipating. The EBITDA is seen at close to 1,730 crore, Margins this time around are slightly subdued on the back of higher raw material prices, and profitability is seen higher by almost 31%, close to the 660 crore mark. What are the key factors to watch as far as the results are concerned? Number one, the Mundra power plant, how is the performance? The production there has been quite strong, almost 52% year-on-year growth has been seen. Also, the distribution circle, especially the performance of the Odisha distribution is something that markets will be keenly anticipating. The EPC segment, strong execution, however, margins here could hurt. While coal prices have been on an upswing, Tata Power benefits from the fact that it has a natural hedge due to its mines in Indonesia, and it is going to be interesting to see what kind of offset the company is able to do. What is it that the market will be looking in terms of the commentary? Number one, update on renewable energy bids, and the solar EPC order book is something the market is keenly anticipating.
All right, Vivek, thanks a lot for that. So this is something we'll be watching out for. The 3 p.m. move is now firmly established, 15 minutes into 3. We have seen it on the upside, closer to that 17,750 mark for the Nifty. And the honours are being taken by the FMCG stocks. In fact, they've been underperforming for the last 2 trading sessions. Just at 3, we saw the FMCG index spike, and that was led by HUL, Britannia, Tata Consumer, all of them recovering from the lows of today's trading session, virtually at the high point. So this is a pack which is doing well. The Nifty holding with gains of almost 90-odd points. A swift recovery of almost 100 points is what we've seen from the lows itself. Let's welcome Amrish Baliga, now market expert. Amrish, your thoughts on the way the market has been moving right now? I mean, it's been in a range, but we are seeing India outperform. And in that, what are the kind of stocks that you like? Because a lot of them are, extremely expensive as well.
Outperformance, yes. I think, last couple of months we have outperformed. But then the way the market has moved in the last 2 days, clearly that, push is not there. That momentum is not there, which we have seen in the last few days. So I think 17,800 clearly is a level to be watched out for. In case we cross that, then surely we should see above 18,000, possibly 18,200 levels. And the sort of stock which I would recommend now is Container Corporation. In fact, Container Corporation is a market leader in the CTO business, having about 65% market share, operating about 61 terminals. So end of last year, the total wagons operated by Concor was about 16,700, 37,500 containers. And they have floated tenders now for about 10,000 more containers. So that's extremely positive. They are in fact increasing the value-added services, which should in fact generate better margins in terminal handling and logistics solutions business. And I think the big trigger for them is going to be dedicated freight corridor. So volume should jump post FY24, but over the next 2 years, I think we should see a large part of the Western DFC commissioning. So every quarter, we could see that Q-on-Q growth. The other trigger for them is PM Gati Shakti framework, which is getting implemented. Though the land lease fee may not really come down immediately, but progressively over the next few years, we could see that helping Concor. So I'm expecting about an 18% revenue CAGR in FY22 to FY25, 3 years. And so expected EPS is about 24. For FY24 is about 28. And my target earlier was 840. But now with this divestment and some majors showing interest in this company, I'm revising my target to 920, as buyouts normally happen at a premium.
Okay, all right. By the way, just keep an eye out on the index. We're back at around 17,750. It's a classic expiry that's played out, and the bulls will be very, very happy. The bears, they'll be fretting right now because we're at around 17,750. Remember, the 17,750 call was being written at will. So that's going to be a bit of an issue. We'll have to keep an eye out on this. But from the lows, big recovery. Nifty Bank as well should come up for you. That was in the red. That's moved well into the green. And now the breadth of the market has improved in favor of the number of stocks that are advancing. So yet again, you have close to 1,500 stocks that are advancing. Keep an eye out on that one. Let's pull up the advanced decline ratio.
So 100-point recovery from the lows. I mean, just look at that chart, right? It's suddenly zooming up in late trade. So it's like a tussle between the bulls and the bears. Through the day, the sort of bears were on top and suddenly the bulls come back in a big way. But one thing is for sure that the 50 DMA of that 17,500 for now is a firm support for the market. So that's something I think the bulls will take with both hands.
And it's been a good series, Sonia, out of nowhere. You know, we started the series below that 17,700, 17,000 odd mark, and we have moved all the way to around 17,750. A good 5% move is what you have seen on the index. That's on the Nifty. And the Nifty Bank has done even better, 8 to around 9% move just in the last 1 month or so. Amrish, stay with us. For the time being, we'll take that final break, come back, and we'll wind down the final 10 minutes of this series and of the day's action. Super recovery for the bulls. Just take a look at that. Now we're holding comfortably above the 17,750 odd mark, and maybe in fact we could see another spurt of around 20-30 points even from here, though we have only around 6 minutes out there, because the shorts have clearly got stuck on the wrong side as we speak. Well, we're still in conversation with Amrish Balega. Amrish, the banks, that's the consensus trade. The large cap banks, they have done well. Now suddenly there seems money is starting to move towards the tier 2 banks, some of the PSU banks as well. What's your pick from there? You know, we had the management of South Indian Bank today. They sounded very, very optimistic. Canara Bank last week was sounded very, very bullish on the way ahead. And some of these banking names are trading still at less than one time. Your take?
In fact, I've been bullish on PSU banks for the last, I think, 18 months or more, and I was proved wrong for a long time. But now I think that performance has come in at this point of time, and I suppose we should see some more upside, especially for stocks like Canara Bank, Bank of Baroda, even a PNB, which was languishing at 35, has finally now started moving up. In fact, there I have a target of about 55 to 58. And among the smaller ones, South Indian Bank has been a pick of mine at least about a year back. So, I mean, after the superb earnings which you have seen, I mean, this stock has moved up. And here, in fact, I mean, I would see levels of about 18 for this stock. And the other one which I think should be looked at is the new listing, TMB, which performed poorly on listing, but now with the sort of numbers which they're showing, I suppose we should see levels of about 580 to 600.
All right, we take that point. Bunch of other stocks which are doing well. You know, consumption retail sort of names are doing well. We have Trent, which is up at the high point. PVR is doing well despite weak collections that we've seen for movies in October. Arvind Fashions, that's the one, along with Inox Leisure. All these stocks are buzzing around. Amrish, post-festive season, are you looking at any of these stocks, or maybe you're still looking at pockets of value?
No, I think one can still look at stocks like Trent or Titan, and in FMCG one can look at Dabur, which just made an acquisition. One can be looking at Britannia, because clearly consumption has in fact moved up quite sharply, especially because of the like festive season. But at the same time, stocks like PVR or Inox, I would be a bit skeptical even at this point of time, because I suppose I mean their operational costs are still high. Whereas we are not really seeing that sort of footfalls, nor are most of the Bollywood films doing well, which is what they're dependent on. Although we have seen southern movies doing quite well, but the Bollywood movie is the major bread and butter for them. So that's not been doing well. So I would be a bit skeptical.
All right. Well, we'll do one thing. Amrish, we thank you for joining in. Have a great day. Thanks for being with us on Closing Bell. Let's close for the day now. We have about 3 minutes left. It's been a tussle between the bulls and the bears today. There was a tough fight and the bulls emerged as the winner. Volatile day of trade. I mean, just look at that. We were down through the course of the day and then that sharp reversal in late trade. The Nifty ends with gains of over 100 points and it was a 100-point recovery just in the last 1 hour of trade, closing above that 17,750 mark. The sensex up almost 300 points by the end. The dips got bought in late trade and the Nifty has now found firm support at that 50-day moving average of 17,500. As we told you earlier, very good end to the series. Great series, by the way, 6% higher for this series. For gainers today, you had JSW Steel, Hindalco, Tata Steel. So metals had top honors, followed by Sun Pharma, Bharti Airtel, Axis Bank, Kotak Mahindra Bank have come back after good results. And on the losing side, you had the Bajaj triplets, Bajaj Finance, Finserv and Bajaj Auto that were under a bit of pressure today. And then some losses, minor losses in names like Wipro, Tech Mahindra as well as Infosys. The market breadth, though, split right down the middle. Tentative sort of market, very volatile. But let's find out. The broader markets had a strong showing, Mangalam.
The second day running, the broader markets actually had a strong showing. The index outperformed the frontline indices. 3/4 of a gain for the mid-cap index. Briefly touching each other were the advanced decline lines, and towards the end, as the markets picked up, we did see the advanced numbers far outweigh the decline numbers. 1,500 stocks advancing for about 1,350 declining. On the way up, we did have big gains in the names like RBL Bank, GMR Infra, IGL for the second day running actually did well. In fact, for the week, the stock is up at almost 12% odd. India Mart is the other one, which also picked up with a gain of almost 5% odd. On the way down, Emphasis was down 3%, Mindtree was down 3%, optically NMDC was down 20%, but that's primarily because it went ex its steel business. TVS Motors saw some profit taking, down about 2.5% odd as well. But safe to say that it was a classic expiry day today, with the markets opening well, then seeing a bit of a decline, then picking up in late trade, only for 17,700 to act as a bit of a fulcrum and ending the series with a near 6% gain. The Nifty Bank ending the series with almost double-digit in terms of gains. Over to November series. That's all we have in October series. So that's as far as the markets are concerned. Thank you so much for watching us here on Closing Bell. You'll just take a short break, come back on the other side. We have big deal lined up for you.